Welcome to the Markets Happy Hour podcast, a weekly markets update for investors the world over. Each week we discuss inflation, geopolitics, interest rates, equity markets, and other asset classes. To try to answer the question, what does this mean for my investment portfolio? Let's dive in.
Well, we always kick off with inflation because this is really our kind of bottom line in terms of all other policies. It seems that the roads lead to inflation and lead from inflation. So what we've been examining over the last really months has been the convergence of inflation really around that coming down, and then expectations, and whether expectations have diverged or converged. It seems they are now on the rise. Interestingly, just as inflation itself seems to be picking up again and on the rise. Whether that's to do with the oil price that's recently jumped again. It has got, this chart only shows it close to 73 a barrel, but we know it had reached, almost touched as high as 80. And equally that the forecasts for price rises are the highest since they have been since 2023. So consumers are now very much in the camp that inflation is not in the rearview mirror and is something to worry about. And this is also something on the Fed's mind. So I'd love to get your current, whether it's a house view or a personal view in terms of where we sit on this inflation continuum.
Yep. There's no, there's single house view at Wellington, just given the breadth and diversity of PMs. Even within an asset class, we'll have multiple PMs. Part of our philosophy is not to have a CIO and a top-down house view that everyone has to conform to. Having said that, I would say, just by way of backdrop, where we in our multi-asset team manage tactical portfolios for clients, we are modestly long duration here. And the view is, I think we wouldn't have that position if we really were concerned about inflation. So I do think, and this is going to be maybe a bit of a theme across our discussion today, it's going to be bumpy. The path is definitely not linear, but we don't really see things falling apart at inflation. If we did, that would not be a good environment where you want to be long duration. The flip side of that is, I would say we're not long duration because we're expecting rates to necessarily move down dramatically. It's really more of think of it almost as a carry trade. We just think we're getting a fair compensation here to own duration, in global government bonds. Yes, there's obviously some risk of things backing up, but the flip side is the nominal and real yield are relatively attractive. So we like that. And in that sense, we're less concerned. To pivot maybe and give a bit of a personal view, again, I feel like what we're seeing in the consumer and the chart on the left, the fact that consumer concern about inflation has picked up, I think that is a little bit of a rearview mirror phenomenon, and just thinking about what happened to oil prices after the conflict. And again, if it turns out we are still on a normalization path, even with some bumps along the way, I think that should come down over time. But you're right to flag that, because I do think if we really get entrenched consumer and labor expectation of inflation being really sticky and high for a long term, that is a potential risk to the economy.
And let's take this into our discussion on geopolitics then a little bit, because it does seem that the only reason geopolitics ever seems to affect investor sentiment is when it moves the oil price.